Hello traders, you're welcome back to the Forex Geek channel. In this particular video, we are going to be breaking down the MACD Double Divergence. It's an advanced but incredibly effective tool in technical trading. This is the ultimate MACD patterns trading guide, okay? Built to help you identify strong momentum shifts and reversal zones before most traders even notice. Now, to understand double divergence, you need to first know what standard divergence is, right? When price makes a higher high, but the MACD makes a lower high, that is bearish divergence. Okay, so let me add the MACD to the chart. Let's be more practical. Okay, so this was an example. We had price make higher high. We had the MACD make lower high. This is a very practical example of a bearish divergence. And you know what happens after a bearish divergence? There is a tendency of the price to decline after a bearish divergence, and that's exactly what happened here. Okay? On the other hand, when price makes a lower low, but the MACD makes a higher low, that is a bullish divergence. All right, let's see if we can find such an example. Okay, you can see the price made a lower low here and MACD made a higher low. Well, the slope was very, very gentle, but just a little bit higher. This was just a little bit higher than this. They're almost at the same level. Meanwhile, this is another example. This one, the price, the slope was very gentle for the price, and then MACD was more obvious. At the end of the day, we had a movement to the upside in both cases. So this is what we call a bullish divergence. All right. Now, MACD double divergence takes this a step further. It happens when two divergent signals appear in sequence, amplifying the probability of a reversal. All right. It's essentially a warning that momentum is not stopping price. It's not supporting price action, I mean. It's a warning that momentum is not supporting price action and something is about to shift. The most important element here is that both the MACD line and the histogram reflect the divergence clearly across two swing points. So this gives us double confirmation of weakening momentum. All right. So to find MACD double divergence, you have to zoom out slightly. All right, you have to zoom out slightly and look for two consecutive price highs or lows that are not matched by the MACD. All right, so for a bullish setup, you will notice that price will make lower lows, but the MACD will make higher lows twice. All right, MACD will make higher lows twice. On a bearish one, price forms higher highs while MACD makes two lower highs. All right. Make sure you are on a clean chart. I recommend using the MACD with default settings 12, 26, 9. You want to look at both the MACD line and histogram to confirm the divergence across both metrics. So when you see that double mismatch between price and momentum, that's a signal to start watching for confirmation. Okay, so once you've identified MACD double divergence, don't jump in blindly. All right, don't jump in blindly. You have to wait for price action to confirm. You look for rejection at a key support or resistance zone. Well, in this particular area, we actually had a rejection candle. You can see this rejection wick we had here, had a shooting star candlestick pattern. If you look closely, you can see the shooting star pattern. And then in addition to that, we had price break below this, right? You can see we kind of had a descending triangle pattern, and well, price initially broke below it, climbed back above it. Well, this is a consolidation phase that we're having around here. In my opinion, you should just stay out of the market if you notice a consolidation like this. All right, you want to have a clear direction. You want to have a clear direction. Okay, so let's just look for a better example where we had a clear direction. All right. Okay, so in this scenario, we can see that we had a bullish divergence, right? And then we had a confirmation. We can see these three white soldiers. You can see this three white soldiers pattern, right? A bullish candlestick pattern. Remember, you should always get a bullish candlestick confirmation for a bullish trade and get a bearish candlestick confirmation for a bearish trade. So we had a bullish candlestick confirmation here, had a little retest here, and then of course we already had our bullish divergence. Would have been a good place to enter a buy, stop loss below the recent swing low, and then you can actually use resistance zones for your take profit. Yeah, you can use resistance zones for your take profit key levels. Now this strategy works across time frames from the 15-minute chart for intraday scalping to the 4-hour and daily for swing trades. All right, you can actually use support or resistance levels for your take profits, or you can even use a fixed risk to reward ratio. The MACD double divergence setup offers precision because it gives you advance warning before the reversal actually kicks in. The MACD double divergence is a simple yet powerful way to read the story behind momentum. It shows you when the market is lying, when price is pushing, but the fuel behind it is fading. Right? So this isn't just a technical pattern, it's a window into the market's heartbeat. Use it wisely and always combine it with solid structure and risk management. If you got value from this breakdown, hit the like button, subscribe to the channel, and turn on the bell so you never miss a high-level trading breakdown like this again. Thank you for watching, and I look forward to seeing you in the next video. Happy trading.